Hi, this is Faisal Haroon. In this video, we will go over why I have developed and trade tactical asset allocation strategies. First of all, the required legal disclaimer. This video is for informational purposes only. Please trade at your own risk with the money you're willing to lose. Please ensure that you agree with the terms of service at the link shown on the screen. If you continue to watch, it will be assumed that you agree. Before diving into why I trade tactical asset allocation strategies, let me clearly explain the key differences between the three main investment approaches that most people consider. Strategic asset allocation. This is the kind of allocation often used in 401k accounts and target date funds, is essentially a set it and forget it approach. You or your investment advisor determines a fixed allocation of several asset classes based on your long-term goals, risk tolerance, and time horizon. This allocation remains relatively static, with only periodic rebalancing to maintain these target percentages. For example, if one asset class performs well and outgrows its target allocation, you'd sell some of it and buy more of another one to get back to your target mix. The underlying philosophy is that markets are efficient over the long term, and your predefined asset mix will deliver appropriate risk-adjusted returns over your investment horizon. The main advantage of strategic asset allocation is simplicity and low maintenance. However, most of us know from experience that this approach seldom generates returns that exceed the market while almost fully participating in market downturns. Stock picking. Stock picking is what most people first think of when they hear the term investing. This approach involves selecting individual companies based on fundamental analysis, technical indicators, or sometimes just popularity and news. The goal is to identify specific securities that will outperform the broader market. You might analyze financial statements, study market trends, follow industry news, or consider a company's competitive advantages. Stock pickers often seek to buy undervalued companies or those with strong growth potential. The potential advantage of stock picking is the possibility of substantial outperformance if you select winners. The drawbacks include higher risk through concentration in fewer positions, the significant time investment required for proper research, and the uncomfortable reality that even professional stock pickers rarely beat market indexes consistently over long periods. Tactical asset allocation. Tactical asset allocation takes a different view on investing. Rather than maintaining a static mix or selecting individual companies, this approach shifts allocations among different asset classes based on changing market conditions and relative strength. They use well-defined and back-tested rules to determine when to rotate between different ETFs representing various sectors, asset classes, or investment factors. Unlike stock picking, tactical asset allocation doesn't try to select individual winners from thousands of options. Instead, it focuses on broader asset classes through ETFs. And unlike strategic asset allocation, it doesn't maintain fixed percentages regardless of market conditions. It adapts to what's actually happening in the markets based on predefined and generally well-tested rules. The objective is to maximize participation in uptrends while reducing risk during significant downtrends. These strategies are designed to systematically move capital towards asset classes showing strength and away from those showing weakness in order to potentially improve risk-adjusted returns over full market cycles. The key difference is adaptability. When market conditions change, whether due to economic shifts, changing monetary policy, or other factors, tactical asset allocation strategies are designed to adjust accordingly rather than just riding through whatever the market delivers. Over the past several years, I've dedicated myself to developing and refining a suite of tactical asset allocation strategies with three specific goals in mind: to generate better returns than the broader market over full cycles, to significantly reduce the depth of drawdowns compared to buy and hold approaches, and to substantially shorten recovery periods after market declines. This wasn't a casual undertaking. I spent years learning, researching, methodically developing these strategies, conducting extensive backtesting against approximately 10 years of market data, deploying my own capital to them, tweaking them when needed, and meticulously analyzing all the significant metrics that matter for long-term investment success. Metrics like Sharpe ratio, Sortino ratio, maximum drawdown, recovery time, and compound annual growth rate. We'll go over these terms in more detail shortly. The strategies aren't based on hunches or gut feelings. They're systematic, rules-based approaches that remove emotion from the investment process. Each strategy has clearly defined entry and exit rules, specific ETF selections, and predetermined allocation percentages, all based on quantifiable market conditions rather than subjective opinions. Understanding these differences is critical because they lead to vastly different outcomes, particularly during major market inflection points. As we'll explore in the next section, these differences in approach can significantly impact both your returns and, perhaps more importantly, your ability to stick with your investment plan through different market environments. Markets aren't static. They go through various cycles, regimes, and phases. Sometimes they're trending up, sometimes sideways, and sometimes they experience significant drawdowns. These strategies monitor these conditions and automatically signal when adjustments are needed. Think about it this way. Modern cars have sophisticated systems that can detect hazardous conditions and adjust accordingly. They don't rely on the driver's gut feeling about when to enable stability control or when to apply the brakes. Similarly, these investment strategies use objective data to determine when to adjust holdings rather than relying on subjective opinions or emotions. Let me be very clear, no investment strategy completely avoids drawdowns. Anyone who promises you that is simply mistaken. However, backtesting shows that the severity and duration of drawdowns can vary dramatically depending on your approach. What makes technical asset allocation particularly valuable is that it can address the psychological challenge of investing during market crashes. Most people simply don't have the emotional fortitude to stay invested while the market is crashing and they're already down 40-50% or more. I've seen too many investors sell at the worst possible times because the pain became unbearable. By developing these strategies from the ground up to navigate through changing market conditions and through extensive testing against historical data, I've verified that these strategies have significantly reduced maximum drawdowns compared to the broader market. Instead of experiencing a 50+% drawdown like the S&P 500 during the 2008-2009 financial crisis, these backtested strategies have historically limited losses to considerably smaller percentages. I don't have to rely on willpower to stay the course. The strategies themselves dictate when to reduce exposure to declining assets or even benefit from strong volatility in the market. Here's something that many people don't fully appreciate. Reducing drawdowns can actually lead to higher long-term returns, even if you miss some of the market's upside. This is because of the mathematics of compounding. Let me explain with a simple example. If your portfolio drops by 50%, you need a 100% gain just to get back to break even. A 100% gain is not only really difficult to achieve, but it can take many years to do so. If you can limit that drop to a more reasonable 25%, you only need a 33% gain to recover, which is not only more achievable, but it takes a shorter amount of time. Moreover, by avoiding deep drawdowns, you start from a higher base when the market recovers, which means your money can compound more effectively over time. This is why many of these strategies have been built to manage risk and have historically produced higher compound annual growth rates than simple buy and hold or strategic allocation approaches, despite sometimes missing part of the market's upside. The math of compounding works in your favor when your strategy can better manage risk. Related to drawdowns is the recovery time, i.e., how long it takes to get back to your previous equity peak. This is something that is often overlooked in investment discussions, but it's incredibly important, especially as you get closer to retirement. Let me give you a concrete example. In the 2008-2009 financial crisis, the S&P 500 experienced a drawdown of over 50% from its October 2007 peak to its March 2009 trough. It then took about 5 years for the market to fully recover to its previous highs, with the S&P 500 recovering all of its losses by March 2013. That's a very long time to wait just to get back to where you started. And during that time, you're not only not making progress toward your financial goals, but you're also likely experiencing significant anxiety about your financial future. It is also important to note that many DIY traders find it challenging to even make the market returns. With these tactical asset allocation strategies, recovery times have been substantially reduced in backtesting through timely asset reallocations. Instead of waiting years to recover from a major drawdown, these strategies have shown the ability to recover in much shorter timeframes. This means getting back to making progress toward financial goals more quickly than the broad market, strategic allocations, or stock picking strategies. Another reason I prefer these strategies is that they systematically utilize a broad array of toolkit of investment vehicles available in modern markets. These strategies don't limit themselves just to the traditional investment vehicles, but they incorporate rules for when to use leveraged ETFs, inverse ETFs, or volatility-based ETFs when market conditions warrant. For example, these backtested strategies include specific conditions for when to utilize leveraged assets during confirmed strong uptrends, or when to deploy inverse or volatility-based ETFs during significant crashes. These aren't gut decisions, they're triggered by specific market conditions that have been tested against historical data. This rules-based flexibility gives the portfolio more options for navigating different market environments rather than being limited to passively riding out whatever the market delivers. The strategies determine which tools to use without being clouded by emotion or recency bias. Let me be clear, even these systematic strategies aren't perfect. The backtesting shows there will be times when these strategies underperform the market for short durations. There will be false signals, there will be periods when being tactical seems unnecessary or even counterproductive. But for me, the historical data makes a compelling case. The backtested results over approximately 10 years shows the ability to adapt to changing market conditions, limit significant drawdowns, recover more quickly from market declines, and potentially achieve higher long-term returns than traditional approaches. What I appreciate most is that I don't have to make subjective calls about market direction. The strategies themselves handle the decision-making based on predefined rules, which are crafted to produce better returns while managing risk. This removes much of the emotional burden from investing and allows me to stick with a consistent approach through different market environments. This isn't about trying to perfectly time the market, that's virtually impossible. It's about having a systematic, rules-based approach that makes reasonable adjustments based on quantifiable market conditions to improve the odds of success over the long term. After successfully trading these strategies for the past couple of years and seeing them perform as expected through different market environments, I've decided to make them accessible to others at a reasonable price. My goal isn't to maximize short-term revenue, but to help other investors achieve better, risk-adjusted returns through proven, systematic approaches that have demonstrated their effectiveness in both backtesting and real-world implementation. Perhaps most importantly, I trade these strategies with my own capital. As a personal rule, I never offer any strategy to others that I do not invest in myself. This ensures complete alignment of interests. These strategies need to work well because my own financial future depends on them just as much as anyone else who might use them. In the next video, I will go over how to understand the performance and execution metrics for these strategies. I hope to see you there.